Are we live?
Yes, we can start now.
Okay. Hello, everyone, and good evening. Welcome to this session. My name is Sonali Palande, and I look after the derivatives product at HDFC Securities. In today's session, we are going to basically form a foundation for our derivatives trading. We are going to see the basic and most important concepts of derivatives, how and when to use them, and how how to form a market view. When you have a market view, how to form a right strategy around it, and also how do we place or execute those strategies or those trades confidently on our platform. So we are going to understand all of this in this power packed session, and I welcome all of you again. So let's get started. Before we start, this is a standard disclaimer. The content and explanation shared in this webinar are only for information and educational purpose. Stock market trading and investment are subject to market risk. Please consult your financial advisor before making financial decisions. Now we are good to go. So first of all, what are derivatives? I believe we have many of the beginners and many of the viewers want to brush up their derivative skills. So let's start from the scratch. So what are the derivatives? Why do we call these particular contracts as derivatives? First and the most important reason behind that is because the price of these contracts is derived from a underlying entity. Okay, I'll give you an example. If you can see on the screen, you can see this TCS 30th September contract and TCS 30th September 3140 CE. Okay, so now this TCS is a cash market stock. Okay, this is a normal stock that you see into the cash market. But this particular contract and this contract, these are the future and options. Okay, so these are the derivatives. So what happens over here when these prices of these contracts change? It may increase or it may decrease, but based on what, right? This particular TCS stocks price will change based on how the company is actually doing, right? But then how the price of the derivatives will change? The price of the derivatives is derived or it is dependent on the price of this particular stock. So in this scenario, this stock becomes the underlying. So when we talk about Nifty's future, Nifty's options, Nifty's call or put, right? So call, put, futures, all of those are derivatives, and price of those contracts is being derived based on how Nifty is performing. Okay, Nifty's price is derived based on how the 50 stocks that are part of Nifty, how they are performing, right? So this is the basic idea or understanding or the concept of derivatives. All right. So now we will go forward and learn more about the futures and options. Now, before we go and learn about futures and options, we should also understand that why derivatives has gained a lot of traction in recent years, or why are we giving this training, or why do we need to trade into derivatives? Simply like that, right? So how it is different from the cash market, how it is, first of all, it gives you a leverage. You can trade based on the margin. You don't need to put the whole money that is required for that particular contract. You get the margin. Second and most important, that you can do hedging with this particular contract. So what happens? Let's say that you have a investment portfolio. All right. Now, investment portfolio, it won't go right away upside, right? There can be some fluctuations into the market. Your portfolio can go down. There can be some market shocks that the portfolio can be, vulnerable to that. So here, based on the derivative contracts, we can actually hedge the portfolio. Whenever you are seeing that there can be some shocks into the market, you can go and hedge your portfolio or a certain stock or a certain script that you are seeing that there can be some negative news into that. So based on particular stock as well, you can hedge. You don't need to just if there is something expected negative into the market, you don't need to just sell off your portfolio. You can simply hedge it. It's like an insurance to your portfolio. So that you can do with the derivatives. Next, we can also diversify with our opportunities that are there into the market. So there can be cash market that you're trading into. There can be, a lot of different opportunities, set of opportunities that are open into derivatives. You can trade into indices. You can trade into the futures. You can create strategies. There are multiple ways to participate into the derivatives market. And also there is very high flexibility in terms of, there can be different set of risk appetites of different set of users, right? Or how much time you want to give to the screen. So there are some option strategies which are risk defined, and you don't need to stay in front of the screen all the time. So a lot of flexibility as per the user's preferences we get into the derivatives. And lastly, the cost efficiency. So if you compare the the cash market and the derivatives market, so the kind of capital that you need to put into the cash market, you can take, multiple times of the position into the derivatives market with the same kind of capital because of the leverage that we discussed at the first, right? So this is, I hope, we have set the enough background for what is derivatives and why we need to participate into it, and why it's a good idea basically to participate into it, right? Now let's go forward and understand how the futures market is different from the cash market. So I suppose all of you understand the cash market, because let's take it as a benchmark that, you have at least once bought some stocks into your portfolio, you have some investment into the stock market, so you understand the cash market. Now how the futures market is different from it, so that you get the clear idea of what is F&O, or what is futures, and what is the cash market, that you already know. Okay, meaning we know the purpose into the cash market is mainly investment. You tend to take this, buy the stocks, and you tend to, keep that into your portfolio for a longer period of time. Now into the futures market, it is not done for a very long period, because it has an expiry date. Okay, everything in the derivatives market will have the expiry date. So these contracts, all the time I'm referring it as a contract, I have never called it as a stock or anything like that, because these are contracts with a limited expiry. Okay, so here after that expiry date, that contract does not have any value. All right, so after a certain period, so for example into futures we get 3 months of contracts at a time. Okay, current, next, and the far month contract. So after that you cannot create a position. So basically you cannot invest into it. It is trading, or it is, arbitrage, that kind of opportunities you take into the futures. Now the delivery, the stocks that you buy into the cash market, you get the delivery into your demat. Here the delivery does not come into the demat, because it's basically not the investment. These are the contracts that you are going to keep till the expiry only, right? Next is the lot size. Now into the cash market you can even buy one stock, right? Or whatever quantity you want to buy. But into the F&O, into futures, or even into options, there are certain lot sizes specified as quantity. Whenever you want to participate into any contract, there are certain lot sizes. So for example, for Nifty, the lot size is 75, right? For Reliance, the lot size is 500. So when you want to participate for that particular contract, you have to go by the lot size. So if you want to buy more quantity than 75, you can go for 2 lots, 3 lots, like that. But you can't take the odd quantity over here. Okay. Now the payment, when we buy the stocks into the cash market, we have to give the full amount. But into the futures market, we get the margin. We basically don't have to pay the whole amount upfront. Okay, it depends on when you are participating into that contract. Is the expiry near, or is the expiry has a little bit of time? So based on that, you get the margin, and you don't have to pay the full amount. So basically when we are participating into the futures market, or even into the options, the view of the market, or view of that particular contract, is comparatively shorter than the cash market. Okay, holding period, as we discussed, into the cash market we can hold it for like generations. There is no limitation. But into the futures market, we can only hold that particular contract till the expiry. Okay, and lastly, when there are any corporate actions, for example like dividends, so you are entitled to get the dividend when you have the stock into your demat, right? That you get from the cash market. But if you have the futures of the contracts, or even options of the contract, you will not be entitled to get that dividend, because you are not a shareholder, you are a trader into that particular contract. Okay, so this is the fundamental difference of these two concepts, and I hope that this clears the air for you. Now let's go forward and let's discuss about the margins. So I have taken out some important topics like, where you may probably have some questions about those concepts. So first and important such concept is the margin. So we talked about we don't have to pay the whole amount. So for example, if you're, buying Reliance. So for Reliance, the futures, quantity lot size is minimum 500, right? If you buy the same quantity into the cash market, it will be around 7,50,000, right? At the near to the LTP. This is just the hypothetical example for the educational purpose. So just to understand the concept. Now, the same contract, if you want to buy into the futures, the kind of margin is going to be very, very on a lower side. If you can see this screenshot I've taken from InvestRight website, and this is the margin calculator. This I've done for the example of Reliance. Okay, so for the same contract, for the same quantity, we only have to pay 1,34,800 approximately. Okay, so this is the kind of difference that we can see into the futures and the cash market margins or cash market payment requirements. So here, how this particular 1,34,000 in this example is formed. There are two types of margins: initial margin and the exposure margin. Now the initial margin is something that is, that you have to pay. Okay, that is like a deposit, right? This is the minimum amount that you have to initiate, that you need to put to initiate that something particular trade, right? So that is initial margin. Now the exposure margin is something like maintenance margin. Okay, so this is going to protect from any fluctuations that are going to be into your M2M due to the volatility of the market. Okay, so whenever this will fall short, you will get the margin call. You will have to add extra capital whenever this exposure margin falls short, and to stay into that particular position, you will have to add the capital. Okay, so based on these two margins, the total margin required is calculated into the futures contract. Now, just like we go towards the expiry, this requirement of the margin will increase. Why? Because there is a possibility that you may want to take the physical settlement of the stocks as well, right? So at that time, the exchange and the broker would want to ensure that you have enough quantity of either stocks or either the margin into your account to fund that particular action. Okay, so this required margin changes depending on how much time is there for the expiry. Now let's go towards the options, the favorite concept of all the traders, right? So we have seen options popularity into all the traders community. Now, how do we use the options? So fundamental usage of options was something else. It was for the rights that were there with the call buyer or the put buyer. So if I go in detail, the call buyer has a right to buy at a certain price. Okay, and the put buyer has a right to sell at a certain price. Okay, this is used when you are going to take the physical delivery based on your option contracts. Okay, but largely the options are traded for the trading or the short term purposes. Okay, here also I have mentioned two basic purposes that we see for the options. Is first is hedging. Okay, you can hedge your portfolio based on this. You can hedge your future contracts with this, or you can form the hedged positions altogether. Okay, multi-leg positions altogether with the help of options. Next is the trading that is done for the short term period. Okay, when I say hedging, the options are available for even yearly expiry. Okay, so yearly or half yearly, quarterly, like that also options are available. It's not just that we have the weekly options or the monthly options. We have the long term or long dated options that are there, especially made for the hedging purposes. And then the trading usage that we all know that we generally see into the weekly options. Now, just like we saw for the futures, there are some certain attributes towards the options as well. Okay, as you can see on my screen, uh, you can see that underlying asset is similar for all the derivative contracts that was there for the futures, that is there for the options as well. Now here, we have two types of options. Into futures, when we had to take an action, let's say you had a positive view on certain stock, you could buy the future of that particular stock, right? Or if you have a negative view on that particular stock, you could sell the future of that particular stock, right? That were the actionables based on the futures. Now here into options, we get two kinds of options. One is call option and one is a put option. Okay. We understood what kind of rates these call option buyers or put option buyers get, but then this is largely or most commonly used for the trading purpose. Whenever we have a certain view on the market, we will see what kind of actionables these option gives you. Now, next is strike price. Now, because over here we get two types of options. This is not as simple as the futures, right? We have the call options and put options. We can, we can do buying, we can do short selling. So there are a lot of, actionables that are related over here. So we also need to have a certain concept for the, which contract we are talking about. So there comes the strike price into the picture. Okay, I'll also show you how the strike prices are placed at what intervals and all of that on the live screen. Now the expiry date. So all the derivative contracts have the expiry date. So the options also have it. Lot size is also same for all the derivative contracts. Now the premium is something that is unique to the options. Now whatever we pay, the price of the options, that is the premium. So let's say if 26,000 nifty call option is listed at 10 rupees, so that 10 rupees is the premium of that option. Okay, so this is how, these are the basic attributes of the options when it comes to the options trading. Now on your screen you can see, so I give you the example of 26,000 nifty call option, right? So here you can see this 25th November 25, this is the expiry date. Okay, nifty is the underlying over here. I'm just making you familiar with the terminologies or how it will look on the live screen. Okay, 26,000 is the strike price and C or P is the type of option that we are trading into. Okay, this 170.80 is the premium. Okay, that this much we have to pay if we have to buy this particular contract, right? And this 75 that you are seeing, this is the lot size. So one lot size will have 75 units. This will, this will be different for different contract, different underlines. All right, now let's go forward. Now we talked about the premium of the option. Now let's say that we saw that Nifty 26,000 call option was priced at 170 rupees. Okay, so how that 170 rupees is derived? How do we decide that this certain option should be priced at this particular price, right? So it basically has two parts. One is intrinsic value and another one is extrinsic value or the time value. Okay, intrinsic value is the basic worth of that option, minimum worth of that option. Okay, so I'll give you an example. Intrinsic value basically is there into only in the money options. Okay, now let's take an example. At, let's say if Nifty is at 26,000. Okay, spot price of the Nifty is trading at 26,000. Now if we look at 25,900 call option, okay, the 100 rupees gap of 25,900, that is the strike price, and the spot price is 26,000. So the 100 rupees gap is the intrinsic value is going to be there into that premium. Okay, now let's say that particular option is trading at 120 rupees. All right, so 100 rupees is the intrinsic value of that particular option. What is the 20, right? That 20 rupees is the time value. So whatever there is extra above the intrinsic value, that is your time value. Okay, now when it comes to the option trading, you must have heard that OTM options or the options that are that have a lower premium or the options which are cheap. Okay, why those are risky ones? Because those are OTM options, out of the money options. Okay, so there is a very less probability that it will, that particular index or that particular underlying will cross that particular level. There is very less probability. That is why they are OTM. Okay, out of the money. Now they will only have time value. Okay, they will not have intrinsic value, and the time value will decrease the way you approach towards the expiry. Okay, that is why trading into the cheaper options is way too risky. Okay, so whenever we have to choose the right strike price, we always have to go with the in the money strike prices. Okay, or max to max. If you are very sure about the momentum, if you are very sure about the direction, we can stick to the at the money strike prices. But OTM strike prices or out of the money strike prices can be very risky. All right, so let's talk about the actionables as well. Now, when it comes to the options trading, we know that there can be option buying and option selling. Option selling is nothing but short selling over here. I'm not talking about squaring off of a contract. I'm talking about the short selling. Okay, selling a contract without owning it on the front hand. Now, what are the actionables to both the people who are the buyers and who are the sellers? Now, let's say that I'm a buyer, okay, and I have a positive view or a bullish view on a certain entity, or let's say market. Okay, what is the actionable for me? I can long a call or buy a call. Okay, because I'm a buyer, this is the primary action that I would want to take. Now, let's say if I have a negative view, if I have a bearish view onto the market, what is the actionable for me? I can long a put or buy a put. Long and buy are the similar words. Okay, I'm just making you familiar with some of the derivative specific terms. Now, this is simple. Okay, option buying is simple. Now, let's talk about the short selling. Now, let's say that I'm a short seller. Now, I have a bullish view onto the market. What's my actionable? I have to short or I have to sell the put. Okay. Let's say that I have a bearish expectation of the market, right? What's the actionable for me? I can short a call. Okay. Or I can sell the call. Why? Because this concept is little tricky. It can be tricky at the beginning, but once you understand it, you will never forget it. Okay, let's go into it. Now, why a bullish trader will short a put? Because see here, when the market is going up, let's say that you're a seller, when will you make profit? Okay, you will make profit if you have sold an option at 100. All right, when the option loses its premium, let's say till 80. Okay, because you have sold it, right? So what will be your profit when it comes to 80? That 20 rupees is your profit. Okay, so as a seller, you would want the premium to go down of that option, right? So when the market goes up, what happens with the put prices? The put prices goes down, right? That is why when you have a bullish view, you have to short the put. Similar way, when the market is bearish, what happens with the call prices? Call prices go down, right? Because see, you are a buyer. These are the simple people. Okay, this buyer is going to buy a call whenever there is a bullish momentum into the market. Now, whenever there is a higher demand to this call option, the price of the call option will increase, right? On the contrary, when the market is going down, the price of the call option will go down and the put option will go up. So whenever this call option price is going down, this is going to benefit the seller or the short seller. Okay, so that is why into the bearish expectation, we have to short the call, right? I hope it is clear to you all. Now, let's take an example. I have already told you that how the buyer makes a profit, how a seller makes a profit. I'll just explain again. This is an example. Let's say that you're a buyer. Okay, your entry is at 20 rupees. All right. Now, let's say that this particular contract has a 25 lot size. Okay, so this is the exit price 270. So as an option buyer, what is going to be your profit? The extra 70 points is your profit. As an option seller, what is your profit? How do we gain the profit? Your entry was at 200. So which means you sold a certain contract, you sold a certain option at 200. Now the option premium goes down to 150. So the 50 points is your profit. Okay. So here one more concept I would want to explain over here is that, we see that here 200 into lot size is the cost of the option buyer. For the option seller, 200 into lot size plus margin is the cost of the option seller. Now option sellers always have to pay extra margin. All right, why that extra margin is required, I'm going to explain that. So many of you would have the question into your mind that why option selling needs a lot of premium or needs a lot of margin requirement. Okay, now for the buyer, let's say that we have taken an position at 200. Okay, so the upside or the reward is unlimited over here, because this 200 rupees option can go to 500, can go to 1000, can go to even 2000 in certain cases. Okay, now what is the risk over here for the option buyer? You have bought it at 200. Now to the lowest where it can go, 0, right? So your risk is defined over here, that is 200. Correct? So here I don't have to put extra mind what are the extra risk towards my position. I know the risk is defined over here. Now about the option seller or the short seller, what happens when you make the profit when the premium goes down, right? So what is your reward over here? You have sold it at 200, so maximum reward over here is limited, that is 200 points. Maximum it can go to 0, right? So that is the maximum you can gain over here. That is the premium decay that's happening, that is the maximum you can gain over here. But what about the risk? This 200, when it starts going towards 220, 250, 300, that is where the option sellers make losses. Wherever they have sold it, if it starts to go beyond that, it is the loss of option seller. Okay, so here this 200 rupees premium option can go to 500, 1000, 2000, any price. Correct? So here the risk is unlimited. Correct? So if you don't put a stop loss, what happens to your position? Your broker is very much worried, right? So that is why the broker will always block some extra margin if you are going into the option selling. Okay, if you have some hedged position towards it, if you buy some position with this short selling position, it will give you a margin benefit. Okay, why? Because now the system understands that the risk that is there into this position is covered. So that is why the broker will also give you some margin benefit. So these are the basic concepts around the option buying, option selling, that we need to understand when we practically do it. Okay, now we also talked lastly about creating a hedge. Okay, so I will briefly talk about the option strategies over here. We will have a very advanced session about the strategies, where in detail I will explain you all the strategies, and in what kind of market condition which strategy to be chosen, and how to execute that, how to check the payoff, all of that we will discuss. But right now, briefly, I'm going to talk about the strategies that when we trade it to options, we can create multiple combinations of two legs. Two legs, legs means contracts, number of contracts. Okay. Now we can create 2-leg strategies, 4-leg strategies, even 20-leg strategy based on your expertise. Okay. Now these basic ones that you are seeing on my screen, these are the single leg contracts. Okay, long or short call that we have seen, long or short put that we have seen, in what condition you take it. Covered call is when you already have the stock into your portfolio and you're expecting a downside, little bit of downside, or you know almost a no momentum into that particular stock. So you can sell the calls. Okay, that particular strategy is called as covered call. So basically you gain that premium. Okay, because the call is going to be anyway become 0 at the end of the month. So here this is called as a covered call. Protective put, you buy a put against your portfolio, against a stock that you have into your portfolio and you are expecting a downside, so you buy a put. So this is like insurance of your portfolio. This is like trying to get something extra above your portfolio. That is why we create covered call. Okay, now these are something very basic and very easy strategies, or these are like one leg strategies. Now medium ones are like bull call spread, bear put spread, iron condor. So these strategies, whenever you have a bullish view, you can create a bull call spread. Wherever you have a bearish view, you can create a bull put spread, bear put spread, or you have a certain range into your mind, you can create a iron condor. Okay, so these strategies have the defined risk, okay, and defined profit as well. So here these strategies are for the risk averse traders. So where you do not want to be exposed to unlimited risk, even if you want to take position into the short selling. Okay, but you don't want to expose yourself to the unlimited risk, or you want to take the overnight positions. You don't want to be exposed to gap ups or gap downs, right? So these strategies are the best options, right? The advanced ones are the straddles. Straddles can be short or long. The strangles, those can also be short and long. So these are the ones where you are little bit of expert into, option trading, and you can go by the strategies. Even if you're not an expert, I'll give you an example and I'll give you a way where you can explore it more. Even the butterfly spread. Butterfly spread is something which is very similar to iron condor. But I'm not going to confuse the beginner audience that we have today. Okay, let's go forward and let's look at the platform. I mean, how the platform of HDFC Securities will help you to make a right market direction view. And when you have a market direction, how do we turn that into a right trade? Okay, so we will see that as well. Now my screen is still shared and I'm going towards our platform. This is InvestRight web platform. Okay, if you're not familiar of this platform, I'll quickly show you how do we log in into it. So when you go at hdfcsec.com, this is the entry point. Okay, trader web. All right, so if you click over here, you can log in based on your existing credentials and you can use the platform. This is open for all the HDFC Securities users. All right. Now, once you log in into the platform, this is the dashboard where you land. Now, when we talk about the futures and options, indices are the most common or the most famous ones, right? So at the top itself, we get the indices. You can set your preference based on what index you want to trade into. Now, first of all, we talked about the futures. So I'll give you an example of the futures. I'll click on Nifty. And here I'm getting a dedicated tab as derivatives. Okay, so I clicked on derivatives. Now this will give me futures and options of Nifty over here. Wherever you click, it will give you the futures and options of that particular entity. Okay. We understood that we at a time get 3 months of contracts live, right? So now you can see November future, December future, Jan future. What is the LTP of that contract? What kind of LTP change that's happening? What kind of built up? So if you can see short covering is something where the short sellers are exiting and there is a upside momentum in that particular contract. Okay. Long built up is where fresh positive positions are being made. Okay, so here you can see in next and next to next month contract, the long built up is being generated. Okay, so this is how the features or the platform that we have, it will give you the basic understanding of the direction of the market as well. Okay, you can also see what kind of volume is being traded over here. So if I click over here, we can see the buy sell buttons. You can also go into the chart and you can also see the option chain. All right, so like this we can quickly place the trades as well. Right now we talked about the options as well. So first of all, very prominent and very important feature of option trading where you can form a view or form a direction is based on the option chain, right? So we talked about the strike prices. So see, this is the whole option chain of Nifty where you can see the strike prices in the middle and call side on your left hand side, put side on your right hand side. Right, you can see the LTP change, open interest. Open interest is something that these many contracts are open at that particular contract. Okay, so this is something the participant of the market are actually holding. Okay, so based on this also we can understand the direction. So I'll give a quick tip over here. So whenever we have to decide what is the quick range of the market, okay, you can see this purple block, that is the spot price of that particular entity. Okay, so what we have to do on the call side into OI column, we have to see a comparatively big number. Okay, from this particular block I'll go down And I can see that this 73 lakh is comparatively bigger, 58, 22, 73. So this 73 is comparatively bigger. Okay. So let's take in mind that this 26,200 has a big call OI. Okay. I'll not say what is it, but big call OI. Now on the put side, we have to do same. Now we are at 26,052. We have to see similar thing. We have to see a bigger number over here. Right at 26,000, we can see 127 lakh. Okay. So now what are we getting? We are getting a range 26,000 to 26,200. Okay. So this put side OI is creating a support. Okay. And the call side OI is creating a resistance. All right. So between the support and resistance, what do we get? We get a range. Okay. And whenever these important levels are being broken, we get a breakout or breakdown. So based on this, you can plan your trades and you can decide the direction of the market as well. To help you understand, if you get confused based on these numbers, if you think that there are a lot of numbers on the option chain, I will help you over here. If you can click on open interest, okay, this will give you a graphical representation. Now the similar thing we can see over here, 26,200 has the open interest that is there on the call side. Okay. And at 26,000 itself, we are seeing big put OI. The call OI is also there, but then, we are already above that level. Okay. So these are the people who are at risk. Okay. Now you can also see overall call OI and put OI. Overall call OI is 13,000, 13 CR and overall put OI is 17 CR. So which means that whenever the put OI, overall put OI is more than call OI, it means that there is a positive undertone of the market. That is when the PCR is more than 1. Okay, put call ratio. When the put OI is more than call ratio, your PCR turns more than 1. Okay, it means that there is a positive momentum into the market. When the call OI is more, it means that more and more short sellers are there on the call side. Okay, they are pushing market down. Okay, the put sellers push the market up, right? So whenever the put OI is higher, the market has a bearish undertone or the negative undertone. Okay, so this is how very quick numbers over here on your screen can give you a quick clue of what is happening into the market. You can also see the change in OI. Change in OI gives you the understanding of what is happening on that particular day. Okay, this is that specific days changes. You can also go into the built up. Now we briefly talked about the built up, that there can be short covering when the short sellers are exiting and it's like a quick upside momentum, right? The long unwinding is when there is a little bit of profit booking. The short built up is when there is a short sellers who are creating fresh positions. So here on this particular page, you can choose future or options and a certain time period, and you can see what's happening in that particular contract. So this will very easily and instantly will give what is happening in terms of open interest and price. Okay, this built up is always taken out with the comparison of open interest and price. So manually doing that is very hard work. Okay, so here this will give you a very, very easy understanding of what is happening in the background in the market. All right, now we have seen what are the basic features that are useful. Also we have of course this is something very basic, but then very, very important, because there are a lot of price action based traders who go by the what is happening on the charts. So we also have charts over here. You can you can place multiple studies over here. Right now on my screen there is Bollinger Bands. Okay, you can also place multiple other studies, and you can study your chart. So here you can also set multiple charts. So if you click over here, it will open as a full screen chart, and multi-chart you have to click, where you can add multiple stocks at one point of time. Okay, if I click on add new chart, here I can add another contract. So this is how we can also use the multiple layout chart system over here on the InvestRight. Now if this all analysis part seems to be a little bit complicated to you, there is a solution from our side, is that we also have a research page. Okay, research page is also handy on your InvestRight app, InvestRight web. All the features that I explained just now are also available on the InvestRight app as well. Okay, those who do not have the derivative privilege yet, it's a very quick and easy method where you can, just activate the derivative privilege based on, one OTP. Okay, so if you don't have it, you can just, go for the process in, T+2 days, you will get it activated, right? Now I was talking about the research insights. So research insights or research page will be visible on your InvestRight app, InvestRight web as well, where you find the recommendations that are given by our seasoned experts. Okay, you can also see what who all are there in our team, and what kind of recommendations they have given, what is the timeline, and with just one click, the actionable is possible. Okay, so this is the research insight. If you have the InvestRight app, okay, you are one step forward. You don't also go on a research page to find out what are the recommendations. If you have your notifications on, you can get the notification for all the recommendations that the research team is giving. Okay, so it's like a alert that you get on your mobile, that this trade is given at that particular moment. This happens within a fraction of second, that here they have uploaded into the system, and you get a notification of a trade. All right, and you can take a action based on that. So this is broadly about the derivatives, and how do we use it, how do we place the options, I mean, how do we place the trades and everything. Right now, one common mistake that we usually observe when the traders do it, right, that is the impulsive trading. Right, we this is very much common into derivatives market, because there is a lot of there is a lot of volatility into the derivatives market. We see a lot of fluctuations. That is why sometimes we see users taking impulsive actions into the derivatives market, and that can lead to the adverse effects. Right, so that is why we have enabled a lot of features where you can do the informed trading, or you can make the informed decisions, and based on that, when you place the orders, you can basically succeed into it. So whenever you are trading into F&O, it is very, very important to make the informed decisions. And because the particular product is little bit complex, but then when you understand it, there is nothing like it. So this is all from my side. Now if we have any questions, we can take that. Also into this market section, you can explore. There are multiple other features as well. So I'll keep it open for you all. Now let's take some questions that we have. So we are live on YouTube. I'll take some of the questions from YouTube that are unique. There is one question: how to find the stock will fall or rise with OI value. So as I explained you that whenever we look at the OI value, if we see that bigger and bigger numbers are present on the call side, okay, it means that the short sellers on the call side are active, and that can bring the price of that stock down. Okay, and if you see more and more bigger numbers on the put side of the OI column, that means that short sellers are active on the put side, and that particular stock's price can go up. So this is how you find the direction based on the OI numbers. Okay, I have got one question, and I'm very grateful that I got this question, because I had almost forgotten this part, that We talked about the strategies, and we talked about, how we can hedge and we can create multi-leg strategies and all of that, right? So we have these two platforms called Insta Option and NXT Option. Okay, these are two integrated platforms which we have taken for advanced features of F&O. All right. So these platforms will have, I'm clicking on NXT Option. I'll give you an example as well. So here you will get advanced features for analysis and execution of the trade. So even if you place your trades from one of these platforms, NXT Option or Insta Option, the orders will go through HDFC Securities only. Okay, and you get to use all these features that are, we have made it available for all our users because we want to serve you better in terms of the derivatives features. Now this platform, I'll specifically go into Strategy Builder. There are a lot of features available. I'll go into Strategy Builder. Here you can see ready-made strategies are also available. Okay, so based on your view, you can take it. You can also build your own strategy. I'll just give you an example of a bull call spread. I'm only clicking on this bull call spread box. Okay, this is giving me a ready-made strategy. You can change the strikes over here. You can change the expiry dates, everything. This will give me the payoff graph. This will show me what is the maximum profit, maximum loss, what is the probability of the profit, everything over here. Okay, and you can, even adjust what kind of lot size you want to trade into, and you can simply trade from here. Okay, so such advanced features you can get on these platforms. We also have something called as easy options. Okay, easy options is where you can, answer simple questions based on, like, where do you see Nifty going in next 7 days. Based on that, if you just answer those questions, the system will give you a strategy based on your view. So you don't even need to understand the names of the strategies. So easy options is something which is built for very, very beginners into the market. So HDFC Securities provide the international indices as well. So foreign market, if you want to see what's happening over there. So if you go into markets and indices, here you can find the Indian indices and the global indices. So let's say that you are an active trader, you want to see what happened in the US market, what happened to Dow, what is happening in the Europe market, what happened in the Asian markets, and based on that you want to be prepared into the opening of the day. You can come here on the global indices and you can check in detail what has happened over here. Okay, so we provide these global indices also. So we have also got a suggestion that we can keep the session into the regional language or in Hindi. I have noted down this feedback. Probably, I can plan the session in Hindi or even Marathi. I can speak Marathi. So, of course, I can take the sessions in regional as well. I have taken the feedback, and surely we will plan that. There is one more question. Please tell how to put stop loss in call or put. So there are two parts to this question. One is deciding what is the level of the stop loss. That can be decided based on the technicals. Okay, where do you see the support? That is the stop loss level. That should be the stop loss level of the price. Another part, technical. How do we put the stop loss? So once you have a position open, you can click on the position. You will get a button called a stop loss. If you click on stop loss, you can put the trigger price and the stop loss price. Based on that, you can put the stop loss into the system whenever you have a position open. So there is a question about carrying forward the option position. Whenever we are placing the trade, or whenever we are executing a trade, on the order pad itself we get two options, intraday and margin. So if we click on intraday, the position is limited till 315. Okay, but if we click on carry forward, you can be you can carry that option or that position for the multiple days. Okay, you can positionally carry it. So I have answered most of the unique questions. So I hope that this particular session was helpful to you, and let me know into the YouTube comments that how you felt this session. Is it going to be helpful to you or not? And please explore all these features. If you do not have derivative segment activated into your account, please do that, because it's a quick action. It will hardly take a minute, okay? Because that is the fundamental step that you will have to take before trading into derivatives market. All right. So I hope that this session was helpful to you all. And this is all from my side. All the best to you all to participate into the derivatives market, and on all the Wednesdays, I'm going to come forward with such live webinars at 4 o'clock, so that we can take up multiple topics regarding the derivatives market, and you should be able to understand more detailed into it, and we can understand various trading styles into derivatives. So thank you so much everybody for joining in. Let me know your views towards this session. Let me know into the comments on the YouTube session, and thank you so much for joining.